So last week, I taught you three important concepts: position size, position risk, and portfolio risk. Today, I want to add two more concepts to your trading vocabulary, which is portfolio exposure and cash position. And we have to relate all of these five terms to current market conditions because these factors change as per market conditions. Okay, so for example, in a weak market, obviously your position size needs to be small if at all you are buying stocks in that market condition. And in a strong market, your position size could be larger than normal. Okay, so let me revise the concepts for you. What was position size, by the way? Position size is the proportion of your portfolio that you choose to invest in a stock. Okay, so 6.25%, let's say, just giving an example. Okay, then what is position risk? Position risk is nothing but your stop loss, right? So you buy a stock near the yellow line, you get the average execution price from your broker, and then you keep a 8% stop loss. Okay, you can choose to keep any stop loss, 4%, 5%, but I'm just giving you general guideline, 8% stop loss. So your portfolio risk is how much? Portfolio risk is the amount of money that is actually at risk, which is position size multiplied by position risk. Okay, which is equal to 6.25% times 8%, which is equal to 0.5%. So half a percent of your portfolio is at risk when you take a 6.25% position size with a 8% stop loss. So which means when you buy one stock in your portfolio, 99.5% of your money is not at risk, and you still have a 6.25% position in the stock. Isn't that a powerful concept? Okay, you are taking a decent position size without taking too much risk. 6.25% position size is neither a small position size nor is it a very large position size. Okay, position size normally minimum recommended is 5% for beginners, and for very advanced experienced professionals the maximum position size is 25%. Okay, till here it is fine. Till here I hope you have understood this is extremely important. And trust me, I speak to traders all over India. They call me, they email me, they send me WhatsApp. Trust me, a lot of them do not understand this basic concept. It was never taught to them properly. Okay. So if you just understand this, you are among the top few traders in India. Okay. So this is very important concept. Sounds very simple, but you can play around with your position size and position risk to manage your overall portfolio risk. So in my previous video, I mentioned that if you want to double this position, okay, want to make it 12.5%, make this 4%. Your portfolio risk will not change. Isn't that a fantastic concept? Sometimes on a daily time frame chart, on a tight base, even 4% risk is like giving enough room to the stock and you still get a 12.5% position size. But do that in a confirmed uptrend market condition. Okay, don't play around when the market is actually in a downtrend. Right, now coming back to the next two concepts, which is portfolio exposure. What is portfolio exposure? Portfolio exposure. Portfolio exposure is the amount of your portfolio that is currently invested. So if you take the current invested amount, or let's say the market value of the current invested amount, okay, divided by your overall portfolio, okay, including cash plus invested amount, everything, that's your portfolio exposure. So for example, let's say you buy four stocks today. Okay. Today is 17th of December. And let's say you choose to buy four stocks today. You had cash position. You started with 100% cash. You buy four stocks with 6.25% position size. So what is your portfolio exposure? Your portfolio exposure is 6.25% multiplied by four stocks, correct? That is how much? That is 25%. So 25% of your portfolio is invested in the market. So if 25% of your portfolio is invested in the market, then what is your cash position? Cash position is equal to 100% minus your exposure, right? Portfolio exposure, which is 75%. So if 25% of my money is invested in the market, then obviously 75% of my money is in cash. Cash means my trading account, my broking account. Okay. Very, very simple concept. There's nothing complicated here. Okay. Now, let's take it one step ahead. Let's go to market conditions. See, these are market conditions. If you are using MarketSmith in India, they just give it to you. Okay. If you are not trading in India, if you are trading the US market, then you will have to study the market conditions chapter from William O'Neill's book and determine how to uh, accurately look at current market conditions by looking at certain general market indices. Okay. The techniques are clearly laid out in that book where you can read the chapter on market conditions. Okay. So in the can slim method, there is the M stands for market condition. So you can read that book, market conditions chapter. But if you are trading in India, MarketSmith just gives it to you for free. Okay. This link is available to anyone. Even if somebody doesn't have a pro subscription, they can still access this link. Okay. It gives you the market conditions. It tells you from what date to what date the market was in what condition. So the market has been in a downtrend recently after 26th of October. It is as attempting to rally. It starts to attempt to make a rally, again goes into downtrend, again tries to rally, again goes into downtrend, again tries to rally. So you can see there is weakness in the market. Okay. That's what this page is all about. Coming back to these four market conditions. In a downtrend, you are not supposed to initiate new positions. In fact, you are supposed to raise cash by selling off your existing position. 50 to 70% of your portfolio should be in cash when the market is in a downtrend. So, in a downtrend, this number should be 50 to 70%. So, your cash position should be 50 to 70% depending on what stocks you have bought in your portfolio, at what level they are from your buy price. Sometimes in a downtrend, you may not want to sell all of your shares. Some stocks might have gone up a lot after your buy price. Okay. So this number, the cash position in a downtrend should be 50 to 70%, preferably 100%. Okay. Because you don't want to be stuck in the market in a downtrend. You want to book all your gains. And you are not allowed to initiate new positions. Okay. Next is rally attempt. In a rally attempt, the market has not yet confirmed that it is going into an uptrend. So you have to be cautious. Here you could buy stocks that are comparatively, technically, and fundamentally strong. You are allowed to initiate new positions. However, your position size should be controlled. Okay. Do not take a very high position size like 15%, 20%. Your position risk, your stop loss should also be kept in control. If you are getting a tight base, there is no need to put a 8% stop loss if you don't have experience. Okay. Go with a tight stop loss and a small position size because the market is trying to attempt a rally and the rally could fail. Okay. In both of these situations, your exposure should be less than your cash position. So let's say your exposure is 40%, then obviously your cash position is 60%. That's okay. That is allowed. But what if your exposure is 65% and your cash position is 35%, that is not correct, because you are you are in a market situation where the overall market conditions are weak, and if you have your exposure is 65%, your cash position is 35%, that means you're exposed to a weak market. Okay, chances are you will lose your realized gains. Don't do that. Okay, coming to uptrend under pressure, here you are allowed to buy stocks that are technically and fundamentally strong. They have to be both technically and fundamentally strong, which is not the case with a confirmed uptrend. In a confirmed uptrend, you could buy fundamentally strong stocks which may or may not be technically strong, because here you can loosen up on your criteria because the market itself is in a confirmed uptrend. So in both of these situations, your exposure could be higher than your cash position. So basically, because of this formula, okay, your exposure decides your cash position, and your cash position decides your exposure. So your exposure should be higher than your cash position, means uh, more than 50% of your portfolio should be invested in the market, because the market is healthy, right? The market is going to give you opportunities, and you have to uh, uh, seize those opportunities in the market. So when the market, your system should be designed in such a way that the market should pull you in when it is healthy, when it is in a confirmed uptrend, and the market should kick you out when the market is becoming weak. Okay, that is how your system should be designed. So your portfolio exposure and your cash exposure should be adjusted based on market conditions. You cannot look at these numbers in isolation. Okay, they are directly related to market conditions. If you are taking a 25% position size in a downtrending market, I do not have a prayer for you. Okay. Please be careful. Don't do all those adventures in the market. You don't need to take that much risk. You just do stress free trading. Just simply relax. Just understand these five terms. Okay. Do not take too much risk, excessive risk. 0.5% is nothing. You can easily take the trade. I have read a lot of books where they recommend this number to be 2%. I mean, that is crazy. I can't imagine 2% is a huge loss for a portfolio on a single stock. Imagine having four trades in a row where it hits your stop loss. You have lost 8% of your money. That's too much, right? So I don't go by the book. Okay, I go by what my experience is. If I am losing more than 0.5%, I become uncomfortable. Okay, I don't want to lose more than 0.5% of my portfolio in a single stock. Okay, I have to be very careful. So these are very robust guidelines for risk management. These are very, what do you say, golden principles of risk management. These are very, very simple uh, five terms that I have shared with you. This should become a part of your trading vocabulary, your risk management vocabulary. Position size, position risk, portfolio exposure, and cash exposure. You should be easily be able to talk about these terms without even thinking about them. Okay, so when you see me make videos on my YouTube channel, when I talk about exposure, cash position, position size, position risk, portfolio risk, now you should be able to understand what I am referring to. Okay, just remember that in a strong market, keep your portfolio exposure high, or your system should be such that your exposure should automatically be higher than your cash position. And when you are in a weak market, your cash position should be more than your exposure. Very simple and a very logical guideline, right? There is no rocket science here. This is basic concept. Your system should automatically keep you away from the market when the market conditions are week. Okay. I hope this has added value to your trading journey. Thank you so much for your time. Thank you so much for your support on this YouTube channel. Take care. Have a fantastic day today.